the hot seat this evening is Eugene Goosen from Ora. Of course, still with us is Andrew Newell from Cannon Asset Managers. Welcome, Eugene, to the show. You know, in a time of chaos and extreme volatility, what does one do when it comes to asset allocation? What strategy makes sense right now?
Yeah, Eleni, hi. Thank you in this new studio. In a market like this, you've got to belt yourself down and be very, very careful. However, I think you've got to be open-minded and ensure that you've got an investment process, or you are being advised by someone with an investment process who can evaluate the markets in a sensible and long-term way. So firstly, forget about your short-term trading. You're going to get burnt if you're not really, really good. And then look around for products that suit your specific risk profile. You know, if you're on the defensive side, you need something with a defensive nature. If you want higher income returns, you've got to focus yourself into products that allow you to achieve that specific goal.
Eugene, I know that we're going to talk on the preference share fund that, of course, you run, and essentially it's quite focused on different elements relative to other asset classes. Why invest in preference shares right now?
Eleni, I think for a starter, the listed preference share market has come down quite aggressively, well, aggressively for that kind of market, and it's yielding very attractively if you compare it to the after-tax return of cash or even the after-tax return of bonds. And for the tax-sensitive investor who is seeking some income return, this type of investment product works very well. It is not a cash investment, so it is someone who wants reasonable capital stability, but a nice and stable source of after-tax return, as preference shares obviously pay dividends.
Eugene, a question is the tax benefits of the dividend funds is obviously attractive, and you've said that they have reasonable capital stability. Could you give us a bit more insight as to the type of volatility this fund might experience? So in other words, how closely related is it to an equity fund, for instance?
Yeah, it's a very good question. If we can start off and look at, say, the all-share index, and we look at the all-share index volatility over the medium to long term, and we can anchor that around anything between 18 and 20% of volatility. In other words, in a normal market environment, how far can it deviate from its mean? Where a fund, where investors invested in preference share would expect a volatility of anything between 5 and 8%. So you in for about half the volatility, and a lot of the volatility being measured is actually just up and down of the preference shares through their dividend cycle. Now, a preference share is very similar to a corporate bond in the sense that they pay a distribution or dividend every 6 months, and they accrue the dividend fairly stably over that term. So it is not a product without risk. I think you do get a bit of a shake around when the tax regime start rewriting the rules. In this environment, the taxman is very clear. The instruments are seen as dividend-paying instruments. We just went through a thorough cleanup on the tax law, and the certainty in terms of dividends is not disputable. So it's a moderately volatile instrument. It's not aggressive.
Is Cannon Asset Managers in any way exposed to preference shares?
We do have some exposure to preference shares, specifically where we have clients looking for yield enhancement. So I think the type of fund that Eugene is talking about certainly is appropriate for clients that want that enhanced income, as well as some kind of a tax shield. Eugene, if I may ask, what sort of liquidity considerations do you place on your fund? Preference shares generally are less liquid than the more mainstream equity markets. How much attention do you give that?
A lot of attention. You know, if you look at the components of I want to go back to a corporate bond, is that each company's got some sort of credit quality, and when you issue instruments, the underlying liquidity of that instrument need to be compensated for. So if it's a low liquidity instrument, obviously you want a higher spread, you want better compensation for that, and vice versa. So in the preference share environment, it's not a very broad universe. If you look at the JSE, you've got 150, 160 shares. The preference share universe is substantially smaller, and it's being dominated by the big four banks, with Investec, also a very active player there as well. So that's where the liquidity lies. However, when we invest in the preference share market for our clients, we are not trading this market. So you will ad hoc realign portfolios and take opportunities. Like for instance, Discovery just came to the market with a pref issue at a very reasonable rate. If the market gets squeezed, you will exit the market very gradually. So on the corporate preference shares, the liquidity starts getting reasonably thin, and we note the risk in that very aggressively. So you don't take big positions in stocks that you can't trade in.
Eugene, what is your benchmark for this fund?
You use after-tax return of cash as your benchmark. I don't believe in tracking the preference share index, purely because of the liquidity story, and also because there are one or two preference shares that are very aligned with equity, and we don't participate in them. We only utilize preference shares that are linked to the prime rate. And
how have you been performing relative to your benchmark then?
It's early days. The fund is fairly young. We expect the pref market to yield clients over the next 12 months in the area of around 6.7, possibly 7%. So it's quite attractive in terms of our after-tax yield.
Yeah. Eugene, let's touch on value strategies right now, and whether you think this is perhaps a time to find a lot of opportunity. It seems that we keep looking at all the negatives, but they say within every crisis there's a lot of opportunity. Would you agree with this? And where are you finding value right now? Of course, you're talking about the preference share fund, which offers a very different strategy for those that want to be protected from the downside in the market. But I'm sure you must be looking at some stocks and going, well, from a valuation perspective, they're looking quite juicy.
Yeah, Eleni, I think the question today is if we look at the companies and the balance sheets and the ROEs that those balance sheets delivered over the past 10 years, so you obviously want to look at companies with some sort of history. To what extent are they going to deviate from those ROEs over the next 5 or 10 years? And interestingly enough, I think if we start looking at our diversified miners and even our more specialist miners, the Kumbas of this world, the expected returns that we getting from their balance sheets or expecting from their balance sheets are looking very, very attractive. If we can just simply use expected P's and see how they compare to trend P's over the past couple of cycles, I think the market is getting reasonably attractive in general from a PE perspective, but diversified miners, and then I still like the credit retailers. Our normal retail stocks are still a bit on the expensive side. I think you guys touched on the construction environment. We are not heavy in it, but I think it's an area where you really have to start looking at the valuations that they are currently discounting. If you need to sit back and wait 2 or 3 years for your return, I'm quite willing to do so.
Fantastic, Eugene. We have to leave it there. Great to have you on the program, Eugene Goosen from Ora Funds.